Welcome to the Strategic Edge. Our mission, as always, is to really cut through the noise and deliver those critical insights that help leaders like you. Today, we're doing a deep dive into what is, well, really a major inflection point for the entire U.S. financial system. We're talking about that landmark financial reform package. It officially passed in July 2025. And look, this isn't just some minor bill signing ceremony. It really marks a monumental shift. It's poised to redefine how capital flows, how businesses operate day to day. Yeah, this isn't just a small adjustment, it's sweeping legislation. And it has two core, really transformative focuses. First, it finally brings comprehensive regulation to digital assets. That's an area that's been operating in a well, let's face it, a fragmented, often uncertain landscape for way too long. And second, it tackles a long overdue overhaul of the accredited investor framework. That fundamentally changes who can invest in private markets. What's truly remarkable, and maybe it speaks to just how necessary this was, is that this consensus, it was actually achieved through rare bipartisan effort, which we don't see too often these days. Now, you might think, okay, this mainly impacts the crypto world, right? And sure, it certainly does. But its relevance, its impact, it extends far, far beyond just that niche. For you, listening right now, whether you're leading a growing startup and managing a dynamic mid-market firm or, overseeing a sophisticated capital-backed enterprise, this bill fundamentally alters your operational landscape. Seriously, it changes how you'll raise capital, how you'll engage with digital assets as a business, your reporting obligations to regulators, and how you prepare for what are definitely going to be increasingly transparent marketplaces. The message here is loud and clear. Strategic advisory, proactive navigation of this new regulatory terrain, well, they're no longer just good practice. They're foundational. Foundational to your operational resilience, your competitive advantage.
And that's exactly why we've tailored this deep dive specifically for you. We get it. In a landscape that's evolving this quickly, you need more than just information dumps. You need clarity. Clarity that directly translates into execution. So our goal today is really to bridge that gap, to help you not just understand these huge shifts, but to actually strategically leverage them for your business's future.
And as always, the Strategic Edge is powered by JF Bicking Co. They're a firm absolutely dedicated to helping leaders like you not just, navigate these complex shifts, but actually turn them into real, tangible opportunities for growth. Okay, let's unpack this. Let's start with the first major pillar, the federalization of crypto and digital asset oversight. For years, it really felt like the digital economy was this patchwork quilt, right? Inconsistent state rules, confusing turf battles between different agencies.
Total fragmentation.
Exactly. This new law, it aims to end that fragmentation. It wants to knit together a unified, structured, and crucially enforceable regulatory fold for the digital economy. It's a historic move, shifting from that inconsistent state-by-state mess to a truly cohesive federal framework.
Yeah, it's more than just tightening up the edges. It's a profound reset, really. This legislation formally brings a whole range of digital assets. Cryptocurrencies, stablecoins, even these newer tokenized instruments. It brings them all under consistent enforceable oversight. For operators, for you listening, this means a significant reduction in regulatory uncertainty, and ideally a clearer path for innovation, but innovation within a defined perimeter. It's fundamentally about building trust in a space that, let's be honest, has often been viewed with a fair bit of skepticism because it lacked that formal structure.
Right. Let's hone in on stablecoins for a minute, because this is where, as they say, the rubber meets the road for so many businesses. Companies that either use or are thinking about using digital payments. We've all seen the headlines, the market volatility, the uncertainty around those USD-backed stablecoins operating under that, dizzying array of inconsistent state charters. So what does this new federal authority specifically mean for them? How does it change things on the ground?
Well, the new reality is a centralized federal authority. It replaces that fragmented landscape with a much clearer, more robust structure. The legislation mandates several critical requirements for these USD-backed stablecoins if they want to operate in the U.S. financial system. First, mandatory reserves, they must hold them. And crucially, these aren't just any assets. They have to be backed specifically by U.S. Treasury assets. It's huge for stability and trustworthiness.
Okay, so actual T-bills, basically.
Exactly. High-quality liquid assets. Second, we're talking about real-time auditing of their liquidity positions. That's a massive leap forward for transparency, making sure that what they claim to hold, they actually demonstrably hold.
Yeah.
At any given moment.
Right. No more guessing.
No more guessing. And third, enhanced solvency and redemption frameworks are now mandated. This is explicitly designed to prevent disasters like, the Terra Luna collapse or the freezing of assets during market stress. It ensures stablecoins are robust, truly liquid and redeemable on demand. It brings much-needed stability to what was, as you said, kind of the Wild West before.
Okay, so stability, transparency, redeemability. What are the downstream implications for, say, fintech platforms or treasury departments?
Oh, they're extensive. If you're a fintech platform, or maybe a banking-as-a-service provider, a BaaS provider, you absolutely must reevaluate your relationships with stablecoin issuers right now. This isn't just a minor compliance tweak. It hits your entire risk profile, your operational integration, potentially your strategic partnerships. It's fundamental. For corporate treasury departments, this means updating policies. How are digital assets held? How are they valued? How are they accounted for? You might actually need to re-architect your entire digital asset strategy to align with these Federal Reserve requirements and the reporting that comes with them.
Can you give an example? Make it concrete.
Sure. Think about a mid-market e-commerce company. Maybe they started using stablecoin payments for international suppliers. Why? To cut transaction fees, speed up settlements, make sense. Previously, they might have just picked a stablecoin provider based on, I don't know, cost or ease of use.
Yeah, the path of least resistance.
Exactly. Now, though, their financial planning, their risk management, it has to directly intersect with the Federal Reserve requirements governing that stablecoin. They need to understand the underlying asset backing. They need to know about the auditing process, the redemption mechanisms. This demands a much, much deeper level of due diligence and ongoing monitoring of their payment rails. Treasury becomes a far more active player in digital asset management now. It's not passive.
Okay, that makes sense. Now, what about security? Those past scandals, lost assets, exchange collapses, just opaque operations, those were painful lessons for everyone involved. It sounds like this legislation is directly tackling those vulnerabilities with these new codified custody, AML, and KYC standards. How do these federal mandates change the operational nuts and bolts for businesses?
Absolutely. They're addressing those vulnerabilities head-on. The new law sets up detailed, enforceable federal standards across 3 critical areas. First, you've got custody standards. These govern exactly how digital assets are held and secured by third parties. It's about protecting investor assets from loss or theft, moving beyond just self-regulation to actual mandated security protocols.
So qualified custodians are going to be key.
Precisely. Second, anti-money laundering AML procedures. These are now federally codified. Clear rules to prevent financial crimes like money laundering, terrorist financing using digital assets. And third, know your customer KYC processes are standardized. This means robust verification of client identity and a thorough assessment of the associated risks. And crucially, these aren't just suggestions or best practices anymore. They are federal mandates with serious teeth, serious penalties for non-compliance.
So what does that mean in terms of immediate actions? What do companies need to do right now?
The execution requirements are stringent, and they're far-reaching. Digital asset exchanges, custodians, even certain wallet providers, they must now register with federal authorities, and they have to submit to regular, rigorous audits. This brings a level of accountability and oversight to these critical intermediaries that just wasn't there before.
Okay, so the infrastructure providers are covered.
Right, but it extends beyond them. If your company is issuing digital securities or even just investing in them, you now have the responsibility to ensure that all your counterparties, your tokenization platform, your chosen custodian, everyone you deal with meet these new stringent federal custodial and AML criteria.
So the due diligence burden increases significantly.
Massively. Vendor due diligence just got a whole lot deeper. And furthermore, think about cross-border platforms. If they want access to U.S. capital or want to service U.S. customers, they must demonstrate compliance with U.S.-aligned KYC workflows. This raises a really important question for every operator out there. What due diligence processes do you actually have in place? What technology solutions are you implementing right now for vetting partners and ensuring ongoing compliance in this new landscape? The old trust me approach, it's completely dead.
Yeah.
You now have a federal mandate to verify deeply, and verify continuously.
Wow. Okay. Let's shift to taxes. For many folks, the tax side of digital assets has been, well, complex, a gray area, often confusing. Wallet-to-wallet transfers, staking rewards, cross-chain swaps. It's been an accounting nightmare for a lot of people. So what does this legislation mean for financial reporting and maybe most importantly for the IRS?
That gray area has been significantly illuminated, thankfully. And yes, it's a game changer for financial reporting.
The legislation creates a new, standardized framework for taxation and reporting of digital assets. It integrates them firmly into traditional financial structures. This includes mandates for real-time cost-basis tracking for wallet-to-wallet transfers, which, as you said, has been a massive headache for individuals and businesses just trying to keep accurate records.
Real-time tracking, that implies some serious tech integration.
It does. It also requires disclosures for digital asset transactions over $10,000, aligning them with the existing cash transaction reporting thresholds. Makes sense. And critically, it integrates digital asset reporting directly into existing IRS Form 1099 structures, like 1099-B or 1099-MISC, potentially new forms too. This means the IRS now has clear, enforceable mechanisms to track digital asset activity, just like it does with stocks or bonds. The visibility is way up.
Okay, so the implications cascade down through the organization, right? What does it mean for, say, token issuers or tax pros or CFOs?
Absolutely, it cascades. For token issuers and fund managers, look, this isn't just about using new forms. It means you must urgently upgrade your compliance tech stacks. You need systems that can meet these automatic information reporting obligations. Your systems need to track, categorize, and report every single digital asset movement with audit-level precision.
That sounds expensive.
It can be, especially initially. Tax professionals, obviously, will need to revise their methodologies completely. Reporting gains, staking income, mining rewards, those complex cross-chain transfers. The rules are now formalized and enforceable. No more ambiguity. And crucially, for CFOs and controllers, this demands integrated, cross-departmental reporting practices. Your digital asset activities cannot live in a silo anymore. They must be seamlessly woven into your main financial ledgers to create audit-proof records that will stand up to federal scrutiny.
Right. So what's the big strategic takeaway here from the sources?
Well, what our sources really emphasize quite profoundly is this. The signal is clear. Digital asset adoption is no longer niche, and treating compliance as an afterthought is no longer tenable. But beyond just the shift to mainstream, the real insight, maybe the slightly sharper edge, is how this legislation might inadvertently favor larger, better-resourced firms.
Oh, so.
Well, while it democratizes access for investors, which we'll talk about, it simultaneously centralizes control and significantly raises the compliance bar operationally. This could potentially squeeze out smaller, maybe more agile players who just lack the immediate infrastructure, the legal teams, or the tech investment needed to adapt quickly.
Interesting tension there.
It is. The core message, though, for every operator, regardless of size, is that organizations proactively retooling their infrastructure now to meet these new, comprehensive requirements, they will inevitably outpace those who are forced into being reactive, scrambling to catch up later. This isn't just compliance, it's a competitive imperative. Proactive wins.
That proactive stance really resonates with what we advocate here at the Strategic Edge. Okay, let's pivot now. Let's move from digital assets to the other massive pillar of this legislation. This is the one that represents a truly generational overhaul for capital formation, the modernized, accredited investor framework. For so long, the definition, who qualified as an accredited investor, was strictly tied to wealth, high income or high net worth, which essentially limited private market access mostly to the already ultra-wealthy. But this reform, thankfully, it recognizes that financial sophistication isn't only about personal net worth.
That's exactly right. Historically, qualifying meant hitting those traditional wealth thresholds, either $1 million net worth, excluding your primary home, or that high annual income, $200K individual, 300-child married couple. And look, those thresholds still exist. But the really significant change here is the expansion of pathways. Acknowledging that expertise, professional knowledge, it can be just as valuable an indicator of sophistication as net worth.
So what are these new pathways? How else can someone qualify now?
Okay, so now, in addition to wealth, you can also qualify if you hold specific securities licenses. Think Series 7, Series 65, Series 82. This is a crucial recognition, right?
Right.
It says professional knowledge, certifications, they demonstrate financial sophistication and an understanding of market risks.
That opens it up to a lot of finance professionals.
It does. Another major pathway is for individuals who successfully pass an SEC-created financial literacy exam. This provides an accessible, merit-based route for people who might not meet the wealth criteria but possess that necessary understanding of complex financial instruments and private market risks.
Interesting, a test.
A test, yes. Finally, professionals employed by qualified fiduciary organizations, think certain investment advisors, maybe trust officers. Their job inherently involves sophisticated financial decision-making and risk assessment. They can also now be considered accredited.
It acknowledges the financial acumen required in roles managing client assets or providing investment advice. This isn't just tweaking the definition, it's fundamentally broadening the concept of financial savvy.
Okay, here's where it gets really interesting, I think. For anyone out there seeking capital or maybe looking to diversify their own investment portfolio, these expanded pathways, they have truly profound strategic implications, don't they? I mean, the addressable investor universe for private placements, it just expands significantly. It genuinely starts to democratize access to these kinds of opportunities.
Absolutely.
Think about it. Suddenly, a seasoned financial planner, someone who advises on multi-million-dollar portfolios but hasn't personally hit that million-dollar net worth yet, they can now directly invest in private deals. They can bring their expertise and their capital to new ventures. That's massive.
It is. It unlocks a whole new pool.
Right. So for startups, for fund managers, this means you can now tap into entirely new pools of capital without, and this is key, without compromising investor sophistication. These new pathways ensure the investors are still knowledgeable, just maybe not in that traditional, purely wealth-based sense. And for financial advisors themselves, this creates exciting new opportunities, new fee opportunities perhaps, as they can now responsibly offer private market exposure to a much wider base of clients. Clients who are financially literate, now legally qualified, but maybe weren't ultra-wealthy before. It's a game changer for both sides of the market.
It really is. But to intelligently balance that expanded eligibility, the bill wisely imposes new obligations on the fundraisers, on the issuers. These new requirements, they act as crucial guardrails, making sure that while access is broadened, investor protection stays paramount, and informed participation is genuinely guaranteed. It's not a free-for-all. It's aiming for a more structured but still inclusive system.
Okay, so what are these new responsibilities for the companies raising money?
Well, they're quite detailed, and they definitely require proactive operational adjustments. Issuers must now implement robust digital verification systems for accredited investor status. This means moving beyond those old, static, often paper-based forms to more secure, scalable, and auditable digital processes, leveraging tech to confirm credentials, whether it's net worth, a license, or passing that exam.
So tech-enabled compliance.
Exactly. Furthermore, there are requirements for enhanced disclosures of investment risks, deal structures. This is a critical legal and operational point. Your legal teams will need to thoroughly revise your private placement memorandums, your PPMs, other offering documents. They need to be clearer, more comprehensive, compliant with these new standards.
More transparency, more detail.
Yes. And crucially, the bill mandates structured education modules. Investors have to complete these before they subscribe. And these aren't just, flimsy one-pagers. They're designed to be interactive, verifiable modules, ensuring investors truly understand the nuances, the complexities, the specific risks of private market investing before they commit capital.
That's a huge shift, a really huge shift. But, I can't help but wonder, does this emphasis on digital verification and structured education potentially introduce new barriers? Maybe for less tech-savvy investors, even if they are financially literate, how do we ensure we're including people without accidentally creating new digital gatekeepers?
That's a very fair point, and something the market will need to address. There's a balance to be struck.
Regardless, the broader impact here seems undeniable. Issuers, fundraisers, they now have to treat investor education and documentation not as some peripheral check-the-box compliance task, but as core functions of their go-to-market strategy for raising capital. It absolutely makes private capital markets more transparent, which is great for investors, but it undeniably adds a significant layer of operational complexity and responsibility for those raising the capital.
No doubt about it. The operational burden increases. But the anticipated benefits for the private markets overall are still seen as significant. This influx of newly accredited investors, it's likely to have several profound impacts. We anticipate an acceleration of deal cycles, an overall increase in investment velocity. Why? Because there's a larger, more accessible pool of sophisticated capital ready to deploy. Fundraising timelines could compress.
Faster deals, more competition.
Definitely heightened competition. Competition between traditional allocators like the established VCs and these emerging direct-to-investor models. Companies can now directly reach a broader, qualified audience, maybe reducing reliance on those traditional gatekeepers.
Interesting dynamic.
Yeah. And furthermore, we'll likely see a significant expansion of opportunities for things like syndicates, special purpose vehicles, SPVs, co-investment structures, these agile structures, the ones that pool capital from multiple investors for specific deals. They become even more powerful tools in a landscape with a wider base of qualified participants.
So, bringing it back to the listener, what does this all mean for you as an operator or an investor navigating this faster, more competitive environment?
Well, what our sources highlight most vividly is this takeaway. Capital raising is becoming both broader and faster. This isn't just a trend, it's the new reality, driven directly by this legislation. And it stresses that, quote, sophisticated systems and processes are no longer optional. They're the key to scaling capital formation without introducing undue risk.
So you snooze, you lose, basically.
In a way, yes. You simply cannot afford to lag behind on digitizing your investor relations, your onboarding, your compliance. The speed of capital deployment will absolutely favor those who are operationally prepared. You need the infrastructure.
Okay. Given all these seismic shifts in digital asset regulation and investor access, it just seems abundantly clear that this new environment demands a truly holistic approach to capital strategy. It's not just about raising money anymore, it's about seamlessly aligning regulatory compliance with your growth objectives, making compliance, dare I say, an enabler, not just a cost center.
Precisely. That's the mindset shift. In this new era, companies must critically evaluate innovative instruments, not just as fringe ideas, but as integral components of their capital stack architecture, moving decisively beyond purely traditional funding methods. This includes exploring sophisticated options, things like tokenized equity, tokenized revenue share instruments. These can offer really novel ways to distribute ownership, secure future revenue streams, maybe introduce liquidity that just wasn't available before in private markets.
Tokenization really seems like a recurring theme here.
It is. We're also seeing a significant uptick in things like convertible debt with embedded smart contracts. Imagine a loan, right?
Yeah.
It automatically converts to equity or maybe triggers specific investor rights once predefined conditions are met. Hit a revenue milestone, secure a key partnership, boom, it executes via code on a blockchain. Removes manual paperwork, reduces human error.
Automated enforcement.
Exactly. And looking even further out, ESG-linked and blockchain-triggered debt products are emerging. Financing terms tied to hitting specific environmental, social, or governance metrics, with blockchain providing that verifiable proof of impact.
Okay, so what's the core benefit of exploring these newer, maybe more complex structures?
The key benefit here is profound. Each of these structures can now be evaluated not just on its traditional cost of capital, but also critically on its compliance posture within this new federal framework. You also evaluate its potential for enhanced liquidity access and its specific appeal to different, now expanded, types of investors.
So it's multidimensional evaluation now.
Right. For instance, take that growing SaaS company needing Series B funding. Instead of just plain old traditional equity, they might strategically offer a portion as tokenized equity. Why? It's not just about efficiency. It might be specifically designed to attract a new type of investor. Maybe a global pool of tech-savvy folks who really appreciate the transparency and programmability a tokenized asset offers. These investors can easily verify their accredited status using the new digital tools, making onboarding seamless. It could potentially unlock a capital pool that traditional VCs might just not reach or prioritize. This transforms your capital stack from just a static structure into a dynamic strategic tool.
Okay. You mentioned digital verification for investors earlier and the automation needed. It really sounds like investor onboarding, which, let's be honest, used to be a mountain of paperwork, isn't just about getting documents signed anymore. It feels like a fundamental operational pivot.
You're absolutely right. It's evolving from this laborious administrative task into a highly automated, tech-driven, and genuinely strategic process. The critical automation requirements now include integrating your investor portals directly with sophisticated ID verification systems, document collection platforms. Makes it smoother for the investor, far more secure and efficient for the issuer.
Less friction, more compliance.
Exactly. We're also seeing the embedding of AI-driven investor education modules. And these aren't just generic videos. They can potentially personalize the learning, dynamically test comprehension of complex terms, smart contract mechanics, ensuring real understanding before commitment.
Verification of comprehension, not just completion.
Right. And critically, the seamless storing of immutable transaction records via blockchain. This creates that unchangeable audit trail for every single step, onboarding, investment, everything.
So why is this level of automation so essential now?
Well, it's essential not just for, convenience, it's for managing scale. With this expanded investor universe, manual processes just won't cut it, they'll break. Automation also significantly reduces liability for issuers. You get verifiable, tamper-proof records that stand up
to regulatory scrutiny.
De-risking the process.
Precisely. And maybe most importantly, it allows companies to meet these new, tighter onboarding timelines that are a direct consequence of those accelerated deal flows we talked about. Without automation, you risk being too slow to capitalize on investment opportunities. Or worse, you risk falling out of compliance because of human error or manual bottlenecks. This isn't just about efficiency anymore. It's robust risk management and seizing competitive advantage. Speed matters.
Okay, this sounds like it completely reshapes how companies manage their financial assets day to day. What does this mean for the traditional treasury function? For many companies, that's been a relatively conservative kind of back office operation.
Yeah, the Treasury team's role is undergoing a radical transformation. It's moving from being purely operational to becoming a genuine strategic differentiator. They have to adapt significantly. First, by meticulously segmenting their digital asset holdings based on regulatory classification. Is it a security token? A commodity? A payment token? Understanding which asset falls under which new federal rule is paramount for accurate accounting and risk management.
Knowing what you hold, legally speaking.
Exactly. Second, they must meticulously match liquidity risk to their liability structure, ensuring their digital asset holdings are diversified, accessible enough to meet short-term obligations, while staying compliant with those Federal Reserve requirements for stablecoins and other digital instruments.
Managing liquidity in a whole new asset class.
Right. And third, critically, they must partner only with custody providers that meet the new rigorous federal thresholds for holding digital assets. This isn't a suggestion, it's a mandatory compliance requirement. It impacts your entire digital asset supply chain. Who holds your assets matters more than ever.
So what's the upside? What's the strategic bonus here?
The strategic bonus is substantial. A forward-thinking treasury, one that embraces this, can now serve as a powerful competitive differentiator. By proactively and compliantly managing digital assets, they can enable faster settlement of transactions, especially cross-border payments. That reduces working capital cycles. Big deal. They could potentially achieve higher returns on idle assets through compliant digital investments that leverage new financial protocols. DeFi, maybe, but in a compliant way.
Yield generation potential.
Potentially, yes, within regulated boundaries. And perhaps most importantly, it significantly enhances the company's reputational credibility, demonstrating robust, federally compliant digital asset management. That signals to investors, to partners, to customers that your company is not only innovative, but also mature and trustworthy in navigating this new financial frontier. It's a clear signal of operational excellence.
Okay. As the stakes rise and the landscape shifts so dramatically, what stands out to you about how corporate boards need to adapt? It really sounds like they need to be much more hands-on, much more knowledgeable about these complex areas than maybe they were before.
Absolutely. The board's role is evolving rapidly. It's moving beyond just traditional financial oversight to encompass a much deeper understanding of digital strategy and all its associated risks. Board members now have crucial, expanded responsibilities. They must gain a deep and ongoing understanding of the company's crypto exposure, its digital fundraising strategies, including any tokenized offerings, and how ESG integration plays into the overall capital plan. This requires a real commitment to continuous learning at the board level. They can't just delegate this away entirely.
They need to understand the language.
They do. They also need to be proactive in creating robust policy frameworks that effectively balance innovation and compliance trade-offs. This isn't about being risk-averse. It's about being intelligently risk-aware, knowing where to push boundaries and where to apply strict guardrails based on the new rules.
Strategic risk management.
Exactly. And finally, they must oversee KPI alignment between the capital strategy and the company's stated risk tolerance, ensuring that any digital asset initiatives or new fundraising approaches actually support strategic goals without introducing undue or unmanaged risk.
So what's the best practice emerging here for boards?
The best practice that emerges from this new regulatory environment is, I think, undeniably clear. Make regulatory health a standing, mandatory agenda item at every single board meeting. This isn't something to be just delegated entirely down to legal or compliance departments and only reviewed when there's a crisis. No, it's a strategic imperative. It requires consistent board-level oversight and engagement, ensuring that digital strategy and compliance are intrinsically linked at the highest levels of governance. It needs constant attention.
Got it. Okay, let's connect this to the bigger picture. It's easy, maybe tempting, for some to see all this new regulation as just a burden, another compliance headache, another roadblock to innovation. But true innovators, as we often discuss, They tend to see regulatory clarity not as an impediment, but actually as a strategic advantage, a new frontier for opportunity. Where others see complexity, they find structure they can build upon.
That's precisely the mindset leaders need to cultivate right now.
So with this new regulatory clarity firmly in place, what are the specific tangible advantages of, say, tokenized securities? How can businesses really leverage them now for capital formation in ways they couldn't before?
Yeah, with this new framework, tokenized securities really start to come into their own. They offer compelling advantages over traditional instruments now that the rules are clear. First, much faster settlement cycles. We're talking minutes or seconds, potentially, instead of days for traditional securities. That frees up capital, enhances liquidity dramatically.
Near instant settlement.
Pretty close. Second, they offer built-in investor rights enforcement. Through smart contracts, things like dividend distribution, voting rights, even liquidation preferences. They can be automatically triggered and enforced right on the blockchain. Reduces legal overhead, reduces disputes.
Code is law, in a sense.
In a regulated sense, yes. And third, they enable truly global capital sourcing, but with smart compliance, filters embedded directly into the asset itself. This means you can potentially raise capital from a worldwide pool of investors, but the token itself can be programmed to only allow transfers or ownership to compliant, accredited participants in various specific jurisdictions. It enforces the rules by design.
Efficient, global, and compliant capital raising.
That's the promise. And the use cases are incredibly diverse, really exciting. They could transform previously illiquid or complex assets into investable securities. Imagine real estate syndicates being tokenized, allowing fractional ownership much faster, more granular transactions, democratizing access to property investment.
Makes sense. What else?
Venture capital sidecars could be structured as tokens, maybe providing more liquidity and flexibility for LPs. Music royalties, intellectual property securitization, prime candidates, allowing artists, creators, innovators to raise capital against future earnings streams in a compliant, potentially liquid manner, maybe bypassing some traditional gatekeepers. This framework really creates a foundation for entirely new asset classes to be securitized and traded much more efficiently.
Fascinating. Okay, another area where blockchain has always shown immense promise is ESG, environmental, social, governance initiatives. With this new regulatory environment pushing for greater transparency across the board, how can blockchain tech uniquely support ESG efforts? How does it move beyond just nice narratives to verifiable data?
Blockchain can fundamentally transform ESG reporting, moving it from, as you say, anecdotal narratives to verifiable, immutable data. That's the key. Companies can leverage it for real-time tracking of things like emissions, carbon credit offsets, providing an immutable, auditable ledger of their environmental impact that can be shared transparently with regulators, investors, the public.
Proof, not just promises.
Exactly. It can enable automated ESG disclosures, reducing the manual burden, improving accuracy, improving consistency across reports, and critically, it offers tamper-proof audit trails for impact reports, giving stakeholders really unshakable confidence in the data, knowing it hasn't been altered or manipulated after the fact.
That immutable quality is powerful there.
It is, and this connects directly to a major market trend. Investors are increasingly demanding not just the ESG stories, but data-backed proof of impact. They want to see the numbers, the verifiable actions, the demonstrable change. Blockchain delivers that verifiable, auditable truth. It moves beyond claims to concrete, transparent evidence. This positions companies using blockchain for ESG reporting as leaders in corporate responsibility, potentially attracting that growing pool of impact-conscious capital.
Okay, this raises an important question then. How does this new investor landscape, particularly the expanded accredited investor definition and the rise of these tokenized assets, how does it impact high net worth individuals, HNWIs, and family offices? They've traditionally been dominant players in private markets. What new strategic plays open up for them?
Yeah, for these sophisticated investors, the new landscape definitely opens up significant and strategic new opportunities. It shifts their investment approach. Family offices, for example, can now potentially go direct into earlier stage deals with greater confidence.
Yeah.
The due diligence might be streamlined by some of these digital tools. They could potentially bypass layers of fund-to-funds fees, gain more granular control over their portfolio construction.
More direct access.
More direct access.
Yeah.
High net worth individuals, they can utilize these new digital platforms and tokenized securities to bypass some traditional intermediaries, access private market opportunities more efficiently, and potentially with greater liquidity than before, depending on how secondary markets develop.
Reducing friction for them, too.
Right. And for issuers, this means they can now build highly niche investor pools.
around specific sectors, specific technologies, even specific missions. They can tailor their capital raise to a precise audience that really resonates deeply with their vision.
More targeted fundraising.
Very targeted. The strategic play here is pretty clear. Use segmentation, community, and tech to build loyal investor bases that compound capital over time. It's about building deeper relationships, maybe fostering a community around shared investment theses, and definitely leveraging technology to create efficiency and transparency. This allows HNWIs and family offices to access a wider, more diverse array of private opportunities, while also empowering issuers to connect directly with the most aligned capital for their specific needs, all fueled by this newfound regulatory clarity and the technological advancements happening in parallel.
Okay. To really bring all these conceptual shifts into sharper focus, let's walk through a hypothetical scenario. Let's make it concrete. Imagine a mid-market firm, let's call them Apex Innovations. Apex is a rapidly growing B2B software company, maybe based in Austin, Texas, and they're currently seeking Series B funding to scale up operations, expand into new markets. What would their world look like now?
Okay, Apex Innovations. So prior to this legislation, Apex would likely have faced that common set of fundraising challenges we see often with companies their size. Their efforts probably would have heavily relied on a limited network of traditional VCs. That could lead to a narrower investor pool, maybe less competitive terms.
The usual suspect.
The usual suspects, exactly. Their investor accreditation checks. Probably laborious, lengthy, manual. Significant back and forth with legal with investors, eating up valuable internal resources, slowing down the deal cycle, painful. And their capital stack. Almost certainly just traditional common or preferred equity, limiting their flexibility, limiting their appeal perhaps to a broader, more diverse investor base. That traditional approach often meant slower closes and a more restricted choice of capital partners.
Okay, that's the before picture. Now let's look at Apex Innovations' new strategy post-legislation. How do they pivot from those old challenges to these new opportunities?
All right, so first, their capital stack adaptation. Instead of just going for purely traditional equity, Apex decides to be strategic. They offer a portion of their Series B as convertible debt, but with embedded smart contracts. This allows for automated milestones. Let's say when they hit $10 million in ARR, the debt automatically converts to equity, streamlines future conversions, ensures investor rights are explicitly defined, enforced by code.
Building in the logic.
Building in the logic. They also smartly carve out a small, maybe more innovative tranche as tokenized equity. And they specifically target that new pool of newly licensed accredited investors they can now access, thanks to the expanded pathways. This diversification lets them attract capital from investors who might prefer the potential liquidity or transparency of a tokenized asset. It broadens their appeal.
Smart diversification of the round. What about onboarding?
Next, their investor onboarding transformation. Apex fully embraces the new requirements. They implement an advanced, automated investor onboarding platform. So when a new potential investor comes along, let's say it's a seasoned financial advisor holding a Series 65 license, one of those newly recognized accredited pathways when they express interest, the platform instantly digitally verifies their accreditation status. Real-time, compliant verification, moving beyond manual checks.
Seamless verification.
Right. The platform then presents the required structured education module. This is that interactive digital course. Outlines the risks, Apex's business model specifics, the mechanics of the smart contracts, and the convertible debt. The investor must complete and pass this module before they can even think about subscribing. This ensures genuinely informed participation, and it drastically reduces Apex's manual compliance burden and potential liability.
Education as a feature.
Exactly. Finally, their operational shifts are key. Recognizing Treasury as that strategic differentiator we discussed, Apex's Treasury team establishes a robust partnership with a federally compliant digital asset custodian. This custodian manages that small tokenized portion of Apex's capital, ensures real-time auditing, strict compliance with the new federal custody standards. This isn't just about security, remember. It's about demonstrating cutting-edge, compliant financial operations to all potential investors. It signals a forward-thinking approach to their entire financial infrastructure.
And the powerful result of all this.
Yes.
Apex Innovations successfully leverages these new regulations, not just to broaden their investor base beyond the traditional VCs, but also to significantly streamline their entire capital raising process. They reduce ongoing compliance overhead through automation, and they drastically enhance their appeal by demonstrating these cutting-edge, compliant and transparent financial operations.
That's right.
This is what it really means, I think, to lead and actually thrive in this new era of capital markets. It's about turning regulation into advantage.
Well said.
Okay, as we wrap up this deep dive, the core takeaways from this landmark legislation, they seem incredibly clear and deeply impactful. For every operator, every investor listening, this legislation, it really isn't just about controlling risk or imposing new rules, is it? It feels fundamentally about unlocking new value, building a more robust, more transparent, more inclusive financial system.
That's the goal, yes.
It comprehensively redefines capital formation. It strategically aligns digital and traditional finance in ways we've really only theorized about until now. And critically, it significantly elevates the strategic bar for everyone, all market participants, emphasizing that a proactive, integrated strategy is paramount, way beyond mere reactive compliance.
Absolutely. The vision for the future of capital, driven by these reforms, is genuinely one that's more inclusive, more intelligent, and definitely more infrastructure-driven. It's a future where capital can flow more freely, more transparently, and with greater efficiency. And those who embrace this shift, those who see the opportunity within the structure, well, they will undoubtedly define the next generation of financial innovation and really lead the charge for growth.
Well put. For more resources on navigating this complex yet definitely opportunity-rich landscape, including expert capital planning, strategic advisory services tailored for founder-led businesses, mid-market operators, capital-backed firms like yours, do visit jfb.fyi. JF Bicking Co. is here to empower you to lead in this truly transformative new era. Thanks for tuning in to The Strategic Edge, where clarity meets execution. Stay sharp, stay focused, and lead forward.